Welcome to our weekly update on major global financial news. Today, we will analyze the most relevant topics influencing the markets, with a particular focus on the implications for institutional investors and industry professionals. Main news. The slowdown in global economic growth is one of the most concerning aspects for international financial markets. According to the latest report from the International Monetary Fund, global growth for 2024 has been revised downward to 2.9%, a decline from 3.2% in 2023. This slowdown is attributed to a combination of factors affecting major world economies, with a particular focus on emerging ones. China, long the engine of global growth, is experiencing a significant deceleration. Pandemic containment policies, followed by a cautious slowdown, have led to a decline in domestic demand. Additionally, the Chinese real estate sector, which represents a significant portion of the economy, is facing a liquidity crisis, with several developers in financial difficulty. The resulting reduction in infrastructure investments has further slowed growth. India, despite still experiencing positive growth, is facing challenges related to inflation and public debt management. The Reserve Bank of India's interest rate hikes to contain inflation have reduced the liquidity available for investments, while the rising cost of raw materials, particularly energy, has eroded corporate margins. Global economy. On the global front, uncertainty related to geopolitical tensions, including the conflict in Ukraine and trade tensions between the United States and China, is weighing on economic prospects. These factors are driving a flight to safer assets, reducing capital flows to emerging economies, and increasing volatility in financial markets. Implications for investors. The slowdown in growth increases the risk of recession in several economies. This scenario is prompting investors to seek refuge in assets considered safe, such as government bonds from developed countries. Demand for U.S. Treasury bonds, in particular, has risen, contributing to a flattening of the yield curve. Lower growth expectations are leading to a re-evaluation of prospects for equity markets, especially in cyclical sectors like technology, consumer discretionary, and industry. Investors are revising valuations and price multiples, considering the prospects of lower earnings growth. The global slowdown is strengthening the U.S. dollar, considered a safe haven in times of uncertainty. This strengthening of the dollar is creating pressure on emerging economies, which hold much of their debt in dollars, increasing debt servicing costs and the risk of default. The Federal Reserve's restrictive monetary policy continues to have a significant impact on global financial markets. In the latest Federal Open Market Committee meeting, the Fed raised interest rates by 25 basis points, bringing the Fed funds rate to 5.50%, the highest level since 2001. This increase is part of an ongoing strategy to combat inflation, which remains persistently high in the United States compared to the 2% target. Persistent inflation. Despite a slowdown in inflation rates from the peaks of 2022, core inflation, which excludes food and energy, remains elevated. Service costs, in particular, continue to grow at a sustained pace, fueled by a still tight labor market and resilient domestic demand. The Fed has made it clear that fighting inflation remains the top priority, even at the cost of slowing the economy. Chairman Jerome Powell emphasized that further rate hikes are not ruled out if economic data shows a resurgence of inflation. This approach is preparing the market for a prolonged period of high interest rates, a phenomenon not seen in decades. Effects on financial markets. The increase in interest rates is having a direct impact on financing costs. Companies with lower credit ratings are facing much higher refinancing costs, which could lead to an increase in defaults in the high-yield debt sector. Additionally, the mortgage market has been particularly affected, with a sharp decline in new mortgage applications and a slowdown in the real estate market. Investors are shifting capital from equity markets to bonds and government securities, attracted by the higher yields offered by government bonds. This is creating downward pressure on equity markets, with a rotation from high-growth sectors like technology to more defensive sectors like energy and consumer staples. The yield curve continues to flatten and, in some cases, invert, a signal often seen as a precursor to a recession. The inversion of the short and long-term yield curve indicates that investors expect an economic slowdown and a potential rate cut by the Fed in the medium term. Investment strategies. Investors are increasing their exposure to defensive assets, such as utilities and telecommunications, sectors that tend to perform better in a slowing economic environment and high interest rates. In a context of rising rates and volatile markets, maintaining a higher cash allocation can offer flexibility to seize buying opportunities when equity markets correct. With macroeconomic risks on the rise, global diversification becomes even more important. Investing in assets denominated in currencies other than the dollar, such as the euro or Swiss franc, can offer some protection against exchange rate risk and macroeconomic uncertainty in the United States. Closing news. Another crucial issue concerns Argentina's sovereign debt restructuring. The Argentine government has recently reached a preliminary agreement with the International Monetary Fund to restructure a significant portion of its foreign debt, amounting to about $44 billion. This agreement includes an extension of payment terms and a reduction in interest rates, but requires strict fiscal austerity measures and structural reforms. Argentina's situation remains extremely fragile, with inflation over 100% annually and foreign exchange reserves in constant decline. Holders of Argentine bonds are facing a significant loss in nominal value, with bond prices having suffered a sharp depreciation, trading at stressed levels around 30–40% of nominal value. The restructuring, while necessary, does not solve the country's structural problems, leaving the risks of further defaults open in the future. Another topic of interest is the expansion of the BRICS bloc, Brazil, Russia, India, China, and South Africa, which recently announced its intention to include new members such as Saudi Arabia and Iran. This expansion aims to strengthen the geopolitical and financial weight of the BRICS in the context of an increasingly multipolar global financial system. The impact of this expansion could be significant for the global financial system, especially in terms of diversifying currency reserves and credit lines. The BRICS are working to develop an alternative payment system to SWIFT, based on their own currencies, to reduce dependence on the US dollar. This could lead to a decrease in global demand for dollars and a realignment of international financial balances, with important implications for emerging markets and global monetary policy. Finally, the cryptocurrency market continues to be a hot topic, especially regarding increasing regulation and institutional adoption. Recently, the SEC has intensified its focus on cryptocurrency trading platforms, imposing new compliance rules and initiating legal actions against some of the major exchanges for alleged securities regulation violations. At the same time, there is growing interest from traditional financial institutions in cryptocurrencies, with the approval of Bitcoin ETFs and other cryptocurrencies by various regulatory authorities. This dual track of increased regulation and growing institutional adoption could lead to greater market stability, but also to a polarization between regulated and unregulated cryptocurrencies. In summary, current dynamics show a constantly evolving global financial market, influenced by restrictive monetary policies, sovereign debt restructurings, geopolitical changes, and technological innovations in the cryptocurrency sector. Investors must remain vigilant and ready to revise their strategies in response to these developments. Thank you for following us in this weekly update. Stay tuned for more insights and analysis on global financial markets.